So Bitcoin just became a $1 trillion asset, helping to cement its legitimacy and putting the naysayers out to pasture. But of course, the next question we have to ask is, where does it go from here? How high will it climb in its next rise? So to answer that, our team member Checkmate will use both fundamental and on-chain analysis to better ascertain where Bitcoin is going from here and why it's continuing to do so. What you're about to hear is an excerpt of our analysis service provided to our Omnia members. Omnia is an all-you-can-eat service, providing both a newsletter as well as access to educational courses. If you're looking to maximize your crypto returns this year, well, there's no better investment you can make than in yourself. A link to a limited time special on Omnia is in the bio below, so come join the best community in crypto. We'd love to see you there. Welcome to Ready Set Crypto. This is your brain on blockchain.
Hello everyone, welcome to the newsletter for the 21st of February. So we've got a few milestones we've hit of late. Bitcoin has surpassed 55,000, which is just quite frankly remarkable. It's now a $1 trillion asset class, so we're now talking about serious money. We can actually start looking at these large investment firms that have to take it seriously now. You really can't ignore Bitcoin as an asset. And, honestly, this is truly remarkable. I think everyone's probably surprised at how quickly we went from all-time high to here. But when you actually look at the macro backdrop and the amount of momentum, and when we've got senators putting laser eyes in their profile pictures, Elon Musk's Twitter profile is just currently a Bitcoin logo, right? We're seeing all of this stuff happening. I mean, it feels like froth. It feels like what you would otherwise think a top looks like. But in many regards, when you actually delve into what's going on, it kind of looks very, very real. It looks like it could very well be sustainable. We're getting 1-2% dips and they're just getting bought up. I mean, it is truly remarkable. And I think what we need to really do is look at everything in a very, very big picture, because exact same feeling that we're seeing with Bitcoin right now, where it's like, man, all the models are just exploding. This same feeling is across all markets right now. So, I'm an avid listener of the Macro Voices podcast and also for Real Vision. And we're just seeing this tone in some of the smartest guys in the room saying, you know what, this is actually the new normal. What we are seeing is the inevitability of currency debasement and what it actually looks like in asset prices. So it really is the whole world and people in markets trying to reevaluate and reconstruct their framework to what is very quickly looking like a new reality. So we're going to touch on a few different things today. I think there's a couple of key points I just want to touch on, and then we'll run into an on-chain update at the end. So let's kick into it. So macroeconomic overview, let's go through the really big picture stuff. So almost all macroeconomists, if you were to go back 6 months, were sitting in the deflationary camp, right? So you've got your regular camp of these high-level macroeconomists who are thinking about the future and what's the most probable outcome. Most of them were deflationists, and essentially they're looking at the three simply ginormous deflationary forces, and that's technology, which just literally makes human beings more efficient. We get more done cheaper, so that's going to reduce pricing. Technology is exponentially deflationary. We're looking at demographics, right? So there's going to be plenty more Harolds floating around where you just spend less when you're 65, 70, 80 and going into retirement. And we have the largest generation with the largest wealth pool going from net spenders to net savers and moving into retirement. So the baby boomers retire, and then coupled with that, we've got the world's largest debt. And the only way you can really deal with the amount of debt we have right now is to make it smaller via inflation. And the normal drive for inflation is essentially growing population, growing productivity, more people coming into the market, actually generating value, right? Generating new jobs, generating new capital flows, new GDP. We don't have an increasing population at the moment, particularly in the West. In Asia, they're about a decade behind us. Japan is about a decade ahead of us. We've kind of seen where this is going, and this demographic shift. There's just not as many people being born at the moment. We have a population decline, and that's really going to struggle. We've got massive debt, which has essentially been borrowed from the future. So ultimately, there is a lot of deflation that wants to happen. Now, the problem is that we have an inflationary system, and that debt must have growth. We have a system that requires growth to exist because it's debt fueled. So if the debt isn't being inflated away, eventually it's going to come and bite, and the system simply cannot deal with it. Yep. So I think this is the challenge that central banks have, is that they have essentially created a system that has been unable to flush out all of the dead wood. The forest fire has been unable to occur to actually clear out the bad debt, the zombie companies, the bad choices, so on and so forth. And ultimately, the only way that they can now try to generate inflation is by printing money. So what they are literally doing is propping up the system, because if it collapses, it's an untenable scenario. No central banker and no government wants to have a falling system, and even 20% declines in asset prices right now have just otherworldly level direct implications on stability. So they're in a rock and a hard place, and it's a really, really hard place. So the difference we have with the inflationary forces right now is they're doing direct stimulus. So in 2008, it was essentially propping up corporations who then just put into a QE, buying bonds, and that money just went into assets. Now they're putting money in the hands of people who will spend it. So we've got direct stimulus that is, by all accounts, Janet Yellen recently was saying that it's not a risk of going too small. The bigger risk is going too small on stimulus, not going too big. So they have, average inflation targeting, all of these things. The central banks are hell-bent on printing money. This is the direction that it's going to go. We're already seeing asset price inflation. People are, when you normalize a lot of stocks and commodities and things, when you normalize it to the amount of money printed, they actually look pretty cheap, which is insane. But this is the world that we're in. So, they're a mirror. They are offsetting or showing how much the currency is being debased. And Bitcoin is being the most free market that exists is heading in that path. We're seeing things like supply constraints. So in some commodity markets, certainly in the oil market, there's supply constraints. And we're also seeing in semiconductors and things like that there are supply constraints that are driving prices up. We're seeing in Texas at the moment, there's misallocation of capital into energy resources, and now they're dealing with some fairly serious blackouts. And there's going to be supply constraints that's going to drive up prices for things. Coupled with that, if you get any of these tensions start to blow out, we're going to get more trade disruptions and all that, and that just leads to price inflation. And there's actually interesting. There's a whole layer of China that's coming into this, who they actually also may need to start increasing the price for their goods, which imports then go up, and you just get this supply constraint, or because there is China needs to pay back their debts. They're going to start raking in more money, and that becomes a larger part of their GDP to start clearing some of this debt, and it's just very, very messy. But it is likely that we're going to see prices rise, and it will probably be in select areas. In some areas, it definitely won't. So there will come a point when people start to recognize that there is in fact inflation, and inflation is very, very psychological. In that when you start seeing it happen, people start behaving differently, and then that actually drives inflation higher. So it could be a bit erratic, where we get these spikes in inflation that goes up to 4 or 5% and then pulls back down. But, unfortunately, we still have things like QE that's going to be in operation because markets can't deal without it. The Treasury is getting ready to spend almost 1.6 trillion, I think last I heard, direct into the economy. They're going to start doing things like infrastructure spends, which is going to be employing a load of people to try and fight the recession, and that's going to put more people spending into the economy, and there's just all of these things going on. Simultaneously, we're seeing yields on the 10-year and the 5-year start to creep upwards. There is going to come a point when, the pig on the left-hand side here, which is just so much debt, you can't pay that back. I heard this morning on a Macro Voices podcast that if interest rates go up by 0.5%, right, which is like small on a relative scale, the US expenditure on interest is equivalent to the entire Navy. If it goes up 0.3%, it's equivalent to the entire Marine Corps. If you have it go up 0.8%, which is recently done. You just your interest bill is now the Navy and the Marines combined. I mean that's the scale of money we're talking about for very, very small interest rates. So what is the most likely scenario here is interest rates will try to creep northwards, and central banks are most likely to implement yield curve control, because essentially they have here's their choice. It sucks. It's either they print money to buy the bonds to keep yields down, which is what yield curve control is, because when you buy bonds, you reduce the yield, right? Demand for bonds reduces the yield, and when people are selling bonds, yield goes up. So they're going to print money to either buy bonds, which will decimate the currency, which is probably the most likely outcome, or they allow interest rates to rise naturally until they hit some kind of pain point and the market has a dummy spit, and then they probably have to go to yield curve control anyway. So it's a really, really bad position. But a lot of these big macro guys are transitioning from deflationists into inflationists. So this is the direction that we're likely heading. I've been watching what are the old hands doing, essentially, because the way I look at it, we've got institutions coming in buying in size. We have old money who is basically selling out to retire. They don't like the narrative. They do like the narrative. 50,000 is a pretty attractive price. We bought it at $600 or 3,000, whatever it is. People are starting to essentially liquidate into that strength. Now, that doesn't necessarily mean, right? It's all supply and demand, and we have unprecedented demand. Simultaneously, we have, some of those large holders are going to start cashing out. So there's going to be a tipping point at some stage. So what we're seeing here, in particular, probably this guy here, if we look at, this is the number of addresses with 1,000 BTC. What's been very interesting is since the Elon candle, we've actually had some reduction in that. So let's just look here. Number of addresses, 2,400. 2486, was it? Sorry, 2486, 2435. So 50 wallets, right? So 50 wallets, 50,000 BTC. Maybe have moved. Maybe they've just lightened their position and they're just slightly less than 5,000. This is addresses with 100, so they would otherwise fall down to this category. Seeing a little bit of a liquidation here too. So what this is telling me is we are seeing some of these entities start releasing coins into the market. So 50,000 is a pretty exciting thing. $1 trillion asset class is a milestone. It kind of makes sense. We're going to get a little bit of an off-sell. When we look at balances and accumulation addresses, so these are wallets that have the heuristic of being a long-term holder, where they're actually withdrawing from exchanges. We're not seeing that major sell-off, right? So, I think that what this is saying is that there's probably being a transfer from the very big guys to some of the smaller, there's still people stacking sats, right? That could be what this is telling us. Our exchange balances, right? We're kind of sideways. We're starting that downtick again. So this is promising. This is good to see. It's telling us that the trend is still good. Miners, are continuing to build up their wallet balance, and again, they're relatively small accumulators, but they're not dumping. If we look at things like our time metrics, so our time metrics is how old coins are, and obviously the older they are, the more profit they're going to be in. So there's a link between profit and coin age. So if we look at the coin days destroyed, so how old are the coins that are currently on the move? Let's look at it on a 1-year timeline. We've got a bit of an uptick, so this is saying that there is some older coins coming back to life. We're not talking about the same magnitude as we had back here in the rally up to 40,000, but we're certainly seeing a slight uptick. So I think what this is scaling out, right? These are whales that who bought very, very cheap, scaling out essentially. You can see the same thing in entity adjusted dormancy, which is more or less a very similar metric. We're basically seeing this slow scaling out of profits. Dormancy flow is starting to kick back up. So this is kind of the MVRV version of dormancy, which actually, let's just have a look at that on the big picture so we can kind of see where we are in a cyclical sense. So you can see here, this is more or less defining we're moving. Pretty impressive that we're only just tagging this level here. And maybe that's actually because 2019 was actually a big flush out, right? This was a nice, healthy consolidation prior to this rally higher. But you can see that we tend to exist above this for most of the bull market, and we're really only just getting back above it. So, this is pretty cool. So this could very well tell us that we still have some ways to go, right?